3. Turning due diligence discoveries into negotiation power. Why raw due diligence findings cannot drive negotiation. Due diligence teams deliver reports filled with discovered problems, but these reports alone do not tell you what to negotiate. A finding that says the target company has aging production equipment gives you no negotiation leverage. You cannot walk into a meeting and demand concessions based on vague operational concerns. The seller will dismiss your complaints as subjective opinions or normal business conditions. Effective negotiation requires translating every problem into specific dollar amounts that show financial impact. Only quantified impacts give you the authority to demand price reductions, protections, or structural changes. 3 financial statements that reveal impact. Every due diligence finding affects at least one of 3 core financial statements. The income statement shows how problems reduce annual revenue or increase operating costs. Losing a major customer directly cuts revenue and margin that flows through to EBITDA. The balance sheet reveals asset impairments, new liability recognitions, or equity dilution from discovered issues. Obsolete inventory requires immediate write-downs that reduce the asset value. The cash flow statement captures timing effects, showing when the problem drains actual cash from operations. Product warranty obligations might spread over 5 years, creating ongoing cash outflows long after closing. Why this translation step separates professionals from amateurs. Your investment committee approves deals based on quantified exposures that fit within approved risk thresholds. Without dollar amounts tied to specific financial statement lines, they cannot assess whether to proceed. The seller also respects buyers who present numerical analysis using the seller's own financial data. Quantified arguments backed by their data room information carry weight that general concerns never achieve. Part 2. 4 categories that determine your negotiation approach. Every quantified issue fits into one of 4 categories, and each category demands different negotiation tactics. Category 1 covers price issues where the only fair response is reducing the amount you pay. These are problems that permanently reduce the company's value and require immediate purchase price adjustment. Category 2 includes adjustment issues where you modify the calculation formula rather than the base price. Working capital or debt levels might change between signing and closing, requiring true-up mechanisms. Category 3 addresses protection issues where you shift future risk to the seller through legal provisions. Uncertain losses like litigation exposure get covered through indemnification, warranties, or escrow arrangements. Category 4 involves condition issues where you secure the right to walk away before closing. Regulatory approvals or material business deterioration become conditions that let you terminate without penalty. Matching category to problem characteristics. Large and certain losses always become price issues because you know the financial hit will occur. If inventory is definitely obsolete and will write down by $2 billion, you reduce the price by $2 billion. Large but uncertain losses become protection issues because the outcome remains unclear at signing. Litigation that might cost anywhere from $0 to $3 billion requires indemnification rather than automatic price cuts. Balance sheet items that fluctuate based on transaction timing become adjustment issues with closing formulas. Deal breakers that fundamentally change investment rationale become condition issues giving you termination rights. Part 3. Creating your negotiation issue map. The issue map consolidates all findings into one document showing every problem with its category and your specific demand. Each row lists a single issue with quantified financial impact, assigned negotiation category, and proposed solution. The map also designates priority levels that guide which issues you fight hardest to resolve. Must-have items represent demands you cannot compromise without killing the deal or returning to your committee. Tradable items matter, but can be adjusted in exchange for securing your must-have protections. Nice-to-have items become negotiation throwaway concessions that cost you little, but let the seller claim wins. Avoiding the retrading trap. Sellers strongly resist any price changes after initial agreement and will accuse you of bad faith negotiation. They call this retrading, meaning you are exploiting newly discovered information to renegotiate previously agreed terms. You prevent this accusation by following a disciplined 3-step presentation for every issue. Step 1 states the factual discovery using information pulled directly from the seller's data room. Step 2 calculates the financial impact using the seller's own forecasts, statements, and business assumptions. Step 3 proposes your solution as a logical risk allocation mechanism that addresses the quantified exposure. This structure frames demands as fair risk sharing rather than opportunistic price reduction after signing. Applying the framework to our example. J. Sinus completes due diligence and discovers Micron holds $6 billion in DRAM chip inventory. Analysis of product specifications and customer order patterns shows 42% consists of older DDR4 technology. Market data for similar obsolete semiconductor inventory indicates these units sell at 35% to 45% discounts. J. Sinus calculates $2.5 billion exposure, which equals $6 billion times 42% times 40% average discount. This becomes a price issue demanding $2.5 billion purchase price reduction backed entirely by Micron's own data.